Welcome to this quarterly update for the Magellan Global Opportunities strategy. My name is Alyssa DeMarco, Investment Director at Magellan, and today I'm joined by Alan Pullen and Joyce, Portfolio Managers of the strategy. Welcome.
Great to be here.
Good to be here.
Thanks, team. So Alan, starting with you, it's been an incredibly volatile start to 2026. Can you talk us through some of the market dynamics that we have been experiencing, and then also how this has been informing your outlook for the remainder of 2026?
Yeah, absolutely. It's absolutely been a volatile start to the year. We, of course, started the beginning of the year with, full valuations, but a reasonably optimistic outlook in terms of the economy. We've got some rate cuts in the US late last year. We had some fiscal stimulus coming through. Europe was stable, not growing strongly, but stable. And this was an okay outlook for kind of global equities for the year. One quarter later, and of course, we've had huge AI disruption fears impacting many parts of the market. And then we've had a war in Iran, which has put those rate cuts kind of off the table for now as people start to worry about inflation and the flow through there. In terms of our overall viewpoint, I would say we're still reasonably cautious about the overall market. But there are some opportunities emerging from what's been going on below the surface, which I'm sure we'll dive into. But overall, I would say still a little bit concerned about aggregate valuations. So the aggregate market still pretty fully valued. I mean, despite coming off a little bit this month, in US dollar terms, still up 20% year over year. Market still not paying that much attention to lower risk parts of the portfolio of the market. And quality still underperforming kind of as people are more chasing momentum and kind of hot stocks. Still, despite what is, a little bit of a pullback post the Iran war. So overall, cautious, but excited about some of the opportunities that are emerging.
So Ryan, with that backdrop that Alan has given us, can you talk us through some of the challenges for the Global Opportunities Fund, given that dispersion in returns within global equities, and why you still have confidence in the investment philosophy and style over the long term?
Absolutely. So starting with performance, year to date, we have underperformed the benchmark, which has been disappointing. And there's really two things that are driving kind of individual stock performance at the moment, which is, as Alan talked about, this big debate around AI winner or AI loser, which camp are you in, is driving massive distinctions in performance. And then also, how are you impacted by the conflict in Iran? What's your exposure to oil prices? How sensitive are you to interest rates? So really, those are dominating the conversations and much less on the fundamentals or the medium term. And I'd say when the discussion is very heated and involved, then lots of things get grouped into those and it becomes much more indiscriminate, and we think the nuance gets lost. So just to focus in on a few companies where we're seeing opportunities on the back of some of this pressure on them being mispositioned or perceived as losers in the shorter term. If we think of a business like S&P Global, it got sold off as part of this Fins data analytics sector sell down on AI disruption concerns. We think that is grossly overestimated for them. Around 70% of their profits comes from ratings, indices, benchmarks, where we see very limited AI disruption. The other 30% also incorporates, which is quite a diverse offering, has a lot of proprietary data, has a lot of very workflows that are integrated into compliance, integrated into financial data that needs to be very exact, and you can't afford to have any errors. They're also well positioned as some of their customers look to consolidate and incorporate AI into their offering to put that into their own offering and benefit from some of that consolidation. So we think the sell down there has been significantly overstated and it's provided an opportunity. So that's one that we've been leaning into. Another one I'd say is Universal Music. We've all probably seen examples of AI being used to create different forms of content. Music's one of them, and admittedly it does quite a good job of creating music. What we think this misses is two things. First is the power the stakeholders in the industry have. That's the artists themselves, the labels, the streaming platforms, to protect and grow overall industry revenue and make sure that AI generated content doesn't have a detrimental impact on that. And then second, just the importance of the artists themselves, the person and their ability to connect with fans to make music popular. It's not just the music itself, it's the combination of that music, the fandom, integrating into pop culture, and we don't think AI changes that. Also for them, management hadn't done a fantastic job in our view of giving investors confidence on what the future looked like and how they were allocating capital during that period. Fortunately, we've seen a little bit of a reversal in that in April. The company's started a buyback and now had a takeover offer from Pershing Square as well, trying to unlock some of the value that we saw there, which is positive to see. The last one that I'd talk about is a little bit different, Reckitt Benckiser. Usually a staple company you'd think in uncertain times would go quite well, but we talked about markets responding to near-term dynamics. And so what we have here is a business with oil-based inputs, meaningful oil-based inputs, and also one that's domiciled in the UK, which has less energy independence, and we've seen UK gilts go up more than most other markets. So it's had a significant pullback. Again, if we look a bit longer term, we don't think this impacts the medium-term earnings or value of the business. We only have to go back to 2022, 2023, when we had an inflation spike. Yes, earnings were impacted in the near term, but then they're able to pass those on, recover margins, and the earnings actually grow with the inflation. So we think there's a disconnect there between how the share price is responding because of these near-term pressures, and who knows where oil prices settle out over the next 12 months. But we don't think the fundamental earnings power of that business has changed as a result of this. So those are some examples, and you asked at the start about the investment philosophy and that medium-term time horizon. I think these are examples of opportunities for us to do our job, which is to look for quality businesses, look for where the markets have become a bit too short-term focused and where we think we're getting an opportunity to lean into value, which we have been doing.
Thanks for that scene setting, Ryan. Really important to delve into that dispersion that we've seen in the market over the last 12 months. To close out today, I'd love to hear from both of you on how the portfolio is positioned and why is it that you have confidence that the Global Opportunities strategy is well positioned to take advantage from some of these unique market dynamics that we've been experiencing.
Yeah, so obviously things have changed a little bit so far this year, but we don't overreact to those short-term changes in markets. We react to fundamentals. And really, when I look at the portfolio and the companies, they continue to drive, good earnings outcomes, great cash flows, and are trading at pretty attractive multiples, really. So it's really interesting because I look at the overall market, still fairly fully valued on most metrics. No shortage of risks out there. We're talking about inflation and the war in Iran, potentially a ceasefire at the moment, but who knows what Trump will do next. So, we've got to look through those short-term noise to these companies that are going to compound value over the long term, where we're confident over that 3 to 5 year time frame that we're going to get great outcomes for our investors. And by looking through these kind of shorter term issues, can take advantage of where there is a dislocation in pricing, as Ryan was talking about in some of those stocks. And we're seeing more than average opportunities at the moment. So notwithstanding a market that's pretty fully valued, the portfolio is trading on a lower than market PE for a much, much higher quality companies. I haven't seen that before, right? Within our quality universe, trading lower than the overall market. And when I look at the individual kind of stocks, we're getting stocks where we're projecting shareholder returns. This is a valuation metric we use, but it's in the 20% plus for many high quality companies. So that's actually a very attractive universe at the moment for us. So a bit of a dichotomy there. Like overall market a bit cautious on, but some fantastic bottom-up opportunities. And this strategy, we're going to lean into those opportunities, look through those short-term disconnects where we're confident, we see the risks out there, but we're confident our companies can navigate them, where they've been unfairly sold off. You heard about a few there we leaned into S&P Global, SAP, another high quality company trading at a discount to the market now, still generating great revenue growth. Meta, another great example. Meta has been a key beneficiary of AI as they increase their targeting from their ROI, the return on investment for their advertising, through better targeting, through better adverts, easier advert creation for businesses and onboarding. Great opportunities there. Now trading on less than 20 times forward earnings. It's a business that did 22% revenue growth last quarter. That's amazing value. So bit of a disconnect. We are leaning in where those opportunities are available. And we expect that the companies and the quality and the growth that they're delivering, that will flow through into share price eventually. We'll get over this latest Trump tweet, whatever's going on, and get the compounding returns from those high quality companies.
Thanks, Al.
Not much to add to that. I think, as Alan said, and as Benjamin Graham said, in the short term, the market is a voting machine. In the long term, it's a weighing machine. I think we're seeing a lot of that at the moment with these current debates, and that should play to the strengths of long-term investors that are ready and willing to lean into those opportunities.
Well, thank you, Alan and Ryan. It's been a pleasure chatting to you today, and thank you so much for listening in. Please feel free to share with friends and colleagues.